The role of leverage in Forex, tool or risk. Leverage in Forex trading allows traders to control larger positions with a smaller amount of capital, amplifying both potential profits and losses. Understanding when leverage is a tool or a risk is crucial for success in the volatile Forex market. Leverage as a tool. Leverage acts as a powerful tool when used strategically. It enables traders with limited capital to access the Forex market, where even small price movements can yield significant returns. For example, with 100-to-1 leverage, a $1,000 account can control a $100,000 position. If a currency pair moves 1%, that's a $1,000 gain, doubling the initial capital. This makes leverage ideal for short-term traders, like scalpers, who capitalize on minor fluctuations. It's also valuable for disciplined traders, employing robust strategies, such as trend-following systems backed by technical indicators like moving averages. With proper risk management, tight stop losses, and position sizing, leverage enhances returns without excessive exposure. In stable market conditions, where trends are clear, leverage empowers traders to maximize opportunities efficiently. Leverage as a risk. However, leverage becomes a risk when misused or misunderstood. High leverage magnifies losses just as it boosts gains. A 1% adverse move in the above example wipes out the $1,000 account if no stop loss is in place. Over-leveraging, such as using 500-to-1 ratios, heightens this danger, especially in volatile markets driven by unexpected news like central bank decisions. Novice traders often fall into the trap of chasing quick profits, ignoring risk management. Without a clear plan, leverage can lead to margin calls, where brokers demand additional funds or close positions at a loss. Emotional trading, greed, or panic further compounds the risk, turning leverage into a fast track to account depletion. Balancing the equation. The difference lies in discipline and context. Leverage is a tool for informed traders who use low ratios, e.g., 10-to-1 or 20-to-1. Set strict risk limits, 1-2% per trade, and adapt to market conditions. It's a risk for those who overextend, trade impulsively, or ignore volatility. By mastering risk management and market analysis, traders can harness leverage effectively while avoiding its pitfalls.